Well, USG just has participated in this terrific gold rally that we've had a good upswing in gold in 2024 and especially an acceleration in 2025.
I'm Thalia Hayden with ETF Guide. We're glad to have you with us. Don't forget to join our community by hitting the subscribe button and drop us a note in the comment section below. Despite record volatility in financial markets and widespread fear, commodities have been standout performers and are getting some well-deserved attention. How can investors and financial advisors strengthen their portfolios with ETFs linked to commodities? Here to discuss that and more is John Love, CEO at USCF Investments. Hi, John. Welcome to the show. Great to see you again.
Hi, Thalia. Thanks for having me back. Great to see you.
The USCF Summerhaven Dynamic Commodity Strategy No K1 Fund, ticker SDCI, has delivered impressive outperformance as compared to stocks, bonds, and cryptocurrencies in the face of fear and volatility. Why are investors turning to commodities ETFs right now? Would you say it's inflation, geopolitical risk, or something else?
Yeah, I would say it is both those things, inflation and geopolitics, as well as diversification. If you look at SDCI versus the S&P, SDCI is up about 7% this year as of April 22nd last night, and the S&P is down about 10%. So you've got a 17% spread where commodities, at least in our product SDCI, are doing better year to date. So I think people are looking for that diversification for one thing. We saw the same thing in 2022, so people have a little bit more experience with this in this decade versus the last one where commodities underperformed. Commodities are really providing some of that balance you want in a portfolio. The other thing, though, as you mentioned, there's some significant concerns about inflation. It had been going down. It is down, but with tariffs, trade wars, depending on how this plays out, inflation could be looking at some substantial increases, especially if Fed independence is captured by the administration and we lower interest rates, so there's not even something to fight inflation. Commodities historically have provided a good hedge against inflation, broad commodities. So I think that's playing into it. And then, of course, the geopolitics of it. You have a huge shakeup in global trade right now based on what the U.S. administration is doing, the retaliatory tariffs that are occurring. And we just have to see how that all plays out. But I think that's one reason, or several reasons, people are looking at commodities in 2025 and looking forward.
Gold is trading near all-time highs, and that's been good news for the USCF Gold Strategy Plus Income Fund, ticker USG. How has USG benefited from the upswing in gold prices? And can you discuss USG's unique income strategy as well?
Sure. Well, USG just has participated in this terrific gold rally that we've had a good upswing in gold in 2024 and especially an acceleration in 2025 as people have become risk off and turned to assets that typically they see as protecting a portfolio. Bonds, actually, people are shying away from a bit more, especially U.S. bonds this year. So gold, I think, has benefited even a little more from that. So USG tracks the price of gold by holding futures contracts. Its income strategy is it sells covered calls on those futures. So it basically earns some income on top of the gold positions. Now, when gold is rising, a gold-only strategy may outperform. What's interesting is if you look over the last year, again, looking today's April 23rd, looking back over the last year, you can see that USG has actually kept pace with something like GLD or some of the bigger gold funds, which is interesting because despite this good run-up, you would expect that the covered call strategy, while providing income, it might underperform a little bit, but it's kept pace, albeit we've returned some of that in the form of income. So USG is really a strategy that's designed to let you participate in gold and hold gold long-term, but actually get something that gold usually doesn't provide, which is income. And although it's done well over the last year, looking back, it actually, in flat markets, if gold gets toppy and goes down a little bit, those covered calls are going to offset that. And if gold is flat, those covered calls are going to earn income, even though the gold price isn't doing well. So we think it's a product that gives you that gold exposure, but gives you a little bit something extra.
Makes sense. Copper is becoming an increasingly important critical global material, and it's interesting to see this year's divergence in the performance of copper equities versus physical copper. The United States Copper Index Fund, ticker CPER, is one strategy for getting copper exposure. What's going on right now in the copper market?
So copper is historically, I think, as people know, it's kind of the canary in the coal mine in terms of predicting recessions, the economic cycle. And this year it's up over 20%. So it's interesting because we have a lot of turmoil going on right now. We've got some concerns about recession, inflation, and all of these things, and yet copper's up. So it's either telling us that there isn't going to be a big downturn slash recession, or it's this new story is so powerful that even in the wake of all this economic potential weakness, copper is still doing well. And there's two reasons for that. One, just looking at the supply and the demand side. On the supply side, we are not producing enough copper relative to demand. And it is very difficult to open new copper mines and bring new production online. Sometimes it takes 10, 15 years to get a new mine up and running. And there's all this regulation that people have to go through in order to mine copper. The second thing is copper is already critical to the global economy, but we are seeing a potentially exponential increase in demand for copper as we have data center build outs, the electrification story, AI, and then just world infrastructure that needs repair, growing infrastructure, all of that. So long term, medium term, we have a real strong need for copper worldwide, and there's not enough of it. So I think that's a very bullish story for one commodity in particular. Now, in the near term, there's question about whether, if there's a downturn, will that have some effect on copper? So we've kind of got this push-pull going right now. We saw that copper dropped off in the wake of Trump's Liberation Day tariffs as concerns about global growth materialized, but it's since recovered somewhat, and it has stayed ahead of the broad equity market. You also mentioned that it's done better than copper miners. Copper miners, I think the reason for that is you're exposed, one, to just general equity beta, and two, to idiosyncratic factors with the individual copper miner companies. So it's not a pure play on copper. Sometimes it may do better. Sometimes it may work as almost a leverage play, and other times it won't. But you're taking on a different exposure when you take on miners versus when you take on something like CPER, which is just a pure play on copper.
Switching gears a little bit, the United States 12-month Natural Gas Fund, ticker UNL, and United States Natural Gas Fund, ticker UNG, have both been lifted by higher natural gas prices, and despite volatility, prices have remained firmly up. Why is natural gas performing so well compared to other energy commodities?
Well, the most direct reason this year is sort of the age-old reason. Natural gas, as priced in the United States or really any foreign market, tends to be a more localized commodity. So what's going on in your home market is driving your natural gas prices more than anything right now. Now, there's a lot of things going on, like LNG exports we can talk about in a second. But really what's happened this year is we had a cold winter. We came into the year with natural gas inventories in the United States at pretty much their maximum level over the last 5 years at least, probably their all-time high. We have since dropped down below where we were a year ago and below the 5-year average. So we have about 20% less natural gas in storage right now than we had 1 year ago. So that's just a bullish factor right there. On top of that, I think you do have some sentiment with, as I mentioned, LNG exports. They are projected to rise. We're building out more terminals. There's more capacity there. The trade war has somewhat curtailed some of that story, or at least interrupted it a bit, because if we've got tariffs everywhere, then that's going to impact other countries' interest in our LNG. But I think that story will, is a long-term one that will play out. So as that comes back into focus, we'll probably move away somewhat from this being historically a domestically priced commodity to a more internationally priced commodity. The other thing is that we've moved into this new administration. There's a new sentiment with natural gas where the Biden administration was phasing out fossil fuels, supporting clean energy. The Trump administration has canceled wind farm projects, is kind of got this war on renewables, and that's just naturally going to create demand for natural gas. And it is something that I think the industry and companies look at as, well, it's not a clean fuel, it is cleaner, and we need all the energy we can get. So it is a good commodity to switch to for energy, certainly better than coal or petroleum, as we build out renewables and as we make that energy transition. So all of those factors, I think, have come into play in terms of sentiment. But the bottom line is, this year so far, it's simply supply demand, the age old story with commodities, and the fact that we are below where we were last year.
And one last question before you go, John. Some ETF investors and financial advisors are probably wishing they would have added commodities to their portfolios. It's definitely not too late. So are commodities ETFs more of a hedge, or can they be used as a long-term core allocation?
They can be used as a long-term core allocation, absolutely. It is definitely not too late. While we've had great outperformance with commodities this year, and even looking over the last year, and looking again at 2022, after 2022, depending on what product you looked at or what index you looked at, commodities held up pretty well. The Bloomberg Commodity Index, which is the most widely cited commodity index, kind of the S&P 500 of commodities, you can look at that and kind of see the general level of a broad swath of commodities. If you look at our product, SDCI, we have a very high beta to the Bloomberg Commodity Index, about 90% or higher, which means we track the broad commodity market very well. But we've had better performance relative to the Bloomberg Commodity Index, sometimes by a substantial amount, and that's the case over the last year to date, and so forth. And the reason for that is we don't hold all commodities at the same time. We hold every sector, so we're exposed to basically all these divergent commodities. But the fund has a history of picking the commodities that are more likely to outperform than underperform. And we have an equal weighting strategy. So we have exposure to things like cocoa that did extremely well over the definitely last year in 2024. Last couple of years, it's done well. And we can give you more exposure to some of those other commodities, wherever the good stories come from. So that's a differentiator in terms of the product. But back to your general question, no, it's definitely not too late. And as we see all of these things playing out with the trade war and all of that, we did see commodities come down after the April 2nd tariff announcement from the U.S., but they've since bounced back a bit. That was basically a concern about global growth slowing down. Long term, if you put tariffs on things, you interrupt trading relationships, you tend to make things more expensive. So there's that fundamental in place. The U.S., by its actions, intentionally or not, is driving down the dollar. Most commodities are priced in dollars, and so that creates an incentive for people to buy them, increases demand. So that raises prices as well. And then just over the long term, that's a really critical thing, is if we look back decades upon decades, commodities have kept pace, broad commodities now, and we can look at the BCOM, the Bloomberg Commodity Index alone, just to establish this, have generally kept pace with equities. They have similar risk, they have similar performance over the long term. There are decades where there's divergences. In the 70s, commodities vastly outpaced equities. In the last decade, the 2010s, commodities underperformed, and that was kind of an anomaly. And that divergence is closing up, and we're seeing significant improvements in commodities in this decade. And it seems like the environment we're in is maybe a little more like the 70s than the 2010s. We'll see what happens. But you had really historical outperformance by U.S. equities and historical underperformance in commodities during that time frame. We think that's probably changing, and commodities provide a good balance in your portfolio. Not going to work every year. It's not going to work over every month, but over the long haul, commodities tend to zig when equities zag. So it's a good core holding in your portfolio over the long term.
John, thank you so much for dropping by, and we'll see you next time.
Thanks, Thalia. See you next time. Thanks for having me again. Take care.
Well, that does it for today's episode of Spotlight. If you enjoyed the show, tell us in that comments section below and hit that like button. To learn more about the investment strategies and ETFs we discussed on today's program, be sure to visit USCFinvestments.com. I'm Thalia Hayden with ETF Guide. Thanks for watching, and we'll see you next time.